Hi, for this question, it's another treasury stocks problem where we are going to use both the cost method and the par value method. So this will show an illustration of the difference between the two. So we're given a list of transactions for West Company, and we're going to add straight to the requirements. So the requirements are that we do prepare journal entries. In the first part, we want to follow the cost method, and the second one, we're going to use the par value method. Note that the cost method is used when we intend that the shares will be resold. So the first transaction where we acquired, so first we're doing the cost method. So we're starting with the cost method. Transaction 1, we reacquired 1,000 shares of common stock for $33 a share. So we're going to debit treasury stock using the cost, or what we paid for the treasury stock. So treasury stock for $33 multiplied by the number of shares, 1,000 shares. So we have $33,000, and this is a cash outflow because we bought them back. So cash for the same amount, $33,000. And the next transaction, we reissued 600 out of this 1,000 shares. So when we reissue it, we're going to remove it out of the treasury bucket, and we reissued it for $35 a share. So that means we took the shares, sold them right out. We sold them out. We get cash for it, and we reissued it at a price of $35 a share. So we're getting $35 for each share, and it's 600 shares that we reissued. So that's a debit to cash for this amount, which is $21,000. And then we remove the portion for the 600 shares out of this amount here. So a credit to treasury stock for $33 multiplied by $600, that $33 being the original price that we had on there, so $19,800. The difference is additional paid-in capital from treasury stock. So additional paid-in capital for treasury stock. So we take 21,000, subtract 19,800, so we have 1,200 for additional paid-in capital. Transaction 3, we reissued another 300 shares at $32 per share. Note that it's less than the original price there. So first we get cash, 32 multiplied by 300 shares. So we have 9,600. Then we remove it from our treasury stock bucket here. So a credit to treasury stock. Treasury stock for 33 multiplied by 300. So we have 33 multiplied by 300 is 9,900. Since we are getting less money than what we bought it originally for, we have a debit to additional paid-in capital for treasury stock. So we have a debit to additional paid-in capital treasury stock for the difference. So the difference of $300. The last transaction, we retired the remaining 100 shares of treasury stock. So remember, we bought 1,000, we reissued 300 here, we reissued another 600 here and 300 here, so that's 900. We're left with 100, which we are retiring, meaning we're no longer holding it. So to retire it, we need to remove it from the original common stock that when the company issued it the first time, we recorded common stock par and an additional paid-in capital on common stock. We need to remove that. In addition, we need to remove it from this bucket here. So for the removal, we need to, for the fourth one, let's remove common stock. And the par value was $10, so $10 times 100. So first we remove 1,000 from common stock. We need to remove additional paid-in capital for common stock. This was the original one that was recorded before this. So when it was issued originally in the first place before we reacquired it. So additional paid-in capital for common stock. The way we figure this, the amount for here is what was the price that we got when we issued the shares out in the first place the first time. So since the price originally, these shares had been issued for $35 and the par value is 10, so that leaves $25 went into additional paid-in capital. So $10 times 100, so 2,500 here. We need to remove the shares from treasury stock. So treasury stock for this cost here, 33, multiplied by 100, we have 3,300. The difference between these two transactions, these two amounts here, 1,000 and 2,500, and we have 3,300 on the credit side. When we subtract those, the extra is our additional paid-in capital. So we credit additional paid-in capital for treasury stock for the difference of 200. So $200 is our additional paid-in capital for treasury stock. Now we're going to work on the par value method next. For the par value method, we are going to record it using the par value of the stock, the original, meaning when we issued it the first time, it was a $10 par value. So when we acquire the stock back, the 1,000 shares, we're going to record it at $10. So we're going to debit treasury stock. And instead of putting $33 on there, we're using $10, which is the par value, times 1,000. So we have 10,000 here. Secondly, we are removing the additional paid-in capital. So we're doing this as if we're not going to reissue it. So we're negating what happened before in terms of additional paid-in capital. So additional paid-in capital for common stock is the extra that was received previously. Out of, we received $35 a share. So the extra was 25, so 35 minus $10 here is 25. Multiply that by 1,000, so that is $25,000. At this point, we paid out cash $33 a share times 1,000. So the cash outflow is 33,000. The difference of 2,000 is our additional paid-in capital treasury stock. So we take this, subtract this, we have 2,000 of treasury stock. The second transaction, when we reissued 600 shares of treasury stock for $35 a share, So we get cash. That's cash, and we have 600 shares, and each we got $35. So we end up with $21,000. And when we reissue, we're removing the portion that's here that we had recorded earlier. So treasury stock gets credited for 600 times the $10. So we recorded it at $10. We're removing it at $10 a unit. So we're going to have 6,000 share credit to treasury stock. And the difference from this transaction goes back to additional paid-in capital for common stock. So we credit additional paid-in capital common stock for the difference here of $15,000. The third entry, where we reissued 300 shares at $32 per share. So similar approach, except the price has changed. So we have cash, 300 shares, $32 a unit. So we have 9,600. We remove the treasury stock that we had recorded here. So $10 times 300, that's $3,000. And then we have a difference, so we got 9,600, and we're going to put the difference in additional paid-in capital common stock. So additional paid-in capital common stock for the difference of $6,600. For the last transaction, when we retire 100 shares, we are retiring them at, again, $10. So we're going to retire that 100 shares that are left. So we're going to credit this, close this out, and we are also going to close out common stock par, the original common stock par that was issued when the shares were originally sold to the public. So common stock par gets reduced, so which is a debit. Common stock $10 par. We're going to retire 100 shares, $10 a piece. That's 1,000 shares of debit. And we're going to credit treasury stock for the same amount of $1,000. So the credit is $1,000. So, and that is it for this question.